Hi, everyone. I see folks logging in. I'm going to give it 1 or 2 more minutes just so we give everyone a chance to get into the webinar, and then we will get started. Hi, everyone, and welcome to our first Restoring Neighborhoods Task Force webinar of 2018. We're so glad you could join us. I'm Rebecca King. I'm the Acting Director of Policy for the National Housing Conference. I'm joined in the room by Caitlin Snyder, Policy and Research Associate here at NHC, and Dan Fixler with the Mortgage Bankers Association. We have a really full agenda for you today. Unlike normal months where we kind of bring a topic to you, this month's topic is really what's happening in Washington. It seemed like a good time to touch base on all that's been happening in terms of appropriations and tax reform and housing finance reform. Before jumping into all of that, I am going to touch on a couple of smaller policy updates, and then Caitlin's going to give an appropriations update. And then we will shift to our speakers. We have Olivia Barrow with Enterprise Community Partners, and again, Dan Fickler with MBA. We will close with a quick overview of NHC's Nexus Policy Guide. We just want to make sure you all are aware that it's on our website and know how to use it. So stay on for the whole webinar. And again, you can send questions through the chat box at any time. We are going to pause for questions after each large policy update, so appropriations, tax reform, and housing finance reform. And if you already have questions in mind, go ahead and send them. And I think that is it for opening remarks, so we will just go ahead and dive in. I only have a couple things I wanted to make sure folks were aware of. The first is that the DC District Court has ruled in favor of small area fair market rents. To give a little background, in August of 2017, HUD announced that small area FMRs would be suspended for 2 years to give public housing agencies more time to implement the rule. In October, a coalition of civil rights organizations sued the Trump administration over that decision. And on December 23rd, the chief judge with the U.S. District Court for DC ruled that HUD lacked the authority to suspend the rule. So public housing agencies in the previously announced 23 metro areas will be required to adopt small area FMRs. And her injunction gave a date of January 1, 2018. So that's a very recent development. We still haven't seen anything from HUD about how they're gonna either move forward and or respond to that court decision. So some uncertainty, but it does look like small area FMRs are moving forward. So I wanted to bring that to your attention.
And there is, there's currently in the Federal Register a comment period, and it closes tomorrow, on Friday. It's on the 12th, I believe. And that closes, and that's for a suspension of the rule. So we're not sure how that's going to play out with the court case that just came down. But if you do want to comment, that's open until the 12th.
It's a good reminder, Caitlin. Yes, NHC is putting in comments just to continue to express a couple of concerns about methodology, and also to express our support for the rule. The next thing I wanted to touch on is I wanted to make sure everyone saw that the Federal Housing Finance Agency has published Fannie Mae and Freddie Mac's underserved markets plans. So these are in response to the duty to serve rule. The plans become effective January 1. They are lengthy, but there's a lot of really good information in there about their plans for loan purchase and investment in rural, manufactured, and preservation of affordable housing. So I would at least give the executive summaries a read. Implementation is going to be really important to watch and monitor and give feedback as they kind of move forward with duty to serve. And then the last thing I wanted to raise is that FHFA and Treasury have reached an agreement on the capital reserve for Fannie Mae and Freddie Mac. So they reinstated a $3 billion capital reserve for the GSEs, essentially to prevent a draw and cover fluctuations in income in the normal course of business. So there may still need to be a draw because of the lower corporate tax rate sometime in 2018, but this gives them some cushion and prevention in the short term for a draw. So just wanted to raise those things. And with that, I will turn it over to Caitlin.
Thanks, Rebecca. So federal appropriations run out next Friday, January 19th. That was a short-term CR that was adopted in, I want to say, middle of December or so, and they were hoping they could reach a bipartisan budget deal to raise the caps before then. That does not look likely. They're negotiating a package, but there's a lot of other policy issues that have to be dealt with, and not necessarily an appropriations package, but that are just kind of holding up the entire process. So we're expecting another short-term CR. We've been hearing rumors that it'll go through President's Day around that timing, and that's just to give them some more time to negotiate this bipartisan budget deal to raise the caps. And then we're hopeful that once they get to that February deadline, they'll be in a position to do a full, not quite a full year, February through October CR, and then begin work on FY19 appropriation. If you guys are not already a part of it, I would direct you guys to join the NDD, Non-Defense Discretionary United Coalition. They're putting out a letter. I believe the deadline is this Friday, up to the Hill just to raise the caps for the bipartisan budget deal. So sorry we don't have a ton of clarity. That's just kind of where things are at the moment.
Thanks, Caitlin. Yeah, we were hoping by this time that we would be able to give you lots of great information on federal spending for FY 2018, but to be continued. We will continue to follow appropriations closely and let you know as we know more. With that, I am going to turn it over to Olivia, so give us just a second to tee up her presentation.
Great, thank you, Rebecca. So there might not be much to share about appropriations right now, but there sure is lots of news on tax policy. So again, I am Olivia Barrow with Enterprise's federal policy team, here to provide a broad overview of how the recent tax reform bill will impact affordable housing and community development programs. If you could go to the next slide, Rebecca, that would be great. Thank you. So I wanted to start with this timeline to put into perspective how much really happened in such a short amount of time over the past few months. Normally, a bill of the size of the Tax Cuts and Jobs Act would have taken months of hearings and meetings and various negotiations, but this entire process was finished in less than 2 months from the House introducing its initial version of the bill at the beginning of November until the president signed the final version into law just a few weeks ago, right before the holidays. So, naturally moving this quickly on such a major piece of legislation has created a number of unintended consequences, not just for housing and community development programs. So Republican leadership has indicated that they're hoping to consider a second tax bill early this year to correct some of the issues that were created in the larger tax reform bill that was just passed last month. Next slide. So before I get into the outlook of the next few months, I wanted to first just go over some of the specifics in the tax reform bill to make sure that everyone is up to speed on what ultimately passed. There were, as you know, significant differences between the House and Senate versions of the bill, and it definitely got into the weeds there for a bit. So let's go through some of the specifics. So first, the House bill was introduced and proposed some seriously damaging changes to our key programs, including essentially repealing almost all of the programs that we rely on to do this work, except for the low-income housing tax credit, which was retained from the beginning. What was perhaps most shocking about this initial House version of the bill was the proposed elimination of private activity bonds, which I'm sure most everyone is aware includes the housing bonds, the multifamily housing bonds, that trigger the 4% housing credit. As you know, the 4% housing credit provides critical financing to roughly half of all housing credit projects. So the proposal to eliminate these bonds would have been truly disastrous to our efforts. The estimate is that eliminating bonds would have cost about 800,000 units of affordable housing over the next 10 years. So after the shock of the House bill, the Senate bill was introduced, and we were pleased to see that almost all of our key programs were kept intact, and that included the low-income housing tax credit, just as the House had included it. I will note that throughout the Senate's negotiation process, there were several provisions introduced at various points that would have directly impacted the housing credit, several of these provisions came directly from the Cantwell-Hatch housing credit bill. But these provisions were not ultimately included in the final bill because they did not fit within formal budgetary rules. But I did want to flag that those were included at various points. I'll also mention that Senator Pat Roberts from Kansas also introduced an amendment that would have incentivized rural and veterans housing. But unfortunately, this amendment also proposed reducing all basis boosts across the board from 130% to 125%. And that included existing projects. So this, of course, created various issues for projects that were already in the pipeline. All of a sudden, without the 130% basis boost, these projects had, $500,000 holes blown open in them, and that caused serious issues for a lot of projects. So after some targeted advocacy, though, with Senator Roberts' office, they agreed to remove the amendment from consideration, and we did avoid that negative impact in the final bill. Next slide, please. So fortunately for our work, the final tax bill does retain all of our key programs. This really is a testament to the industry's advocacy throughout this process, and I do want to kind of pause here to take the opportunity to thank all of the advocates and industry stakeholders, many of whom I know are on this webinar, for all of the important work that you completed over the past several months. It really was inspiring to be a part of. However, our advocacy work is certainly not over, since there will be indirect impacts as a result of various provisions in the tax bill, especially with impacts for the housing credit. So the final bill did reduce the top corporate tax rate from 35% to 21%, and we expect changes to the market, to the housing credit market, and some reduced investor demand that will ultimately decrease the number of units that can be built using the housing credit. The bill also created a new tax called the Base Erosion and Anti-Abuse Tax, which limits foreign entities or U.S. entities with significant foreign affiliates from collecting tax credits. And unfortunately, this does include the housing credit and the new markets tax credit, which may have a negative effect on certain investors' demand for these credits. On the more positive side, the final bill does create a new opportunity for community reinvestment, known as opportunity zones. This is actually the first new community reinvestment tool since the Clinton administration, so there is a lot to be excited about with that. The Opportunity Zone program allows governors to designate a certain number of low-income census tracts as opportunity zones, and investors will be eligible to receive a tax benefit in the form of deferred capital gains if they invest their capital in these eligible opportunity zones. The tax bill gave the Treasury Department the authority to create and implement and oversee the Opportunity Zone program, but the Treasury must follow the formal rulemaking process to formally establish the program and implement it before any investments can actually be made. So part of this rulemaking process includes a period for public comments, and then Treasury would consider those public comments, issue a final rule, and the Opportunity Zone program would be able to be officially implemented. So I do want to take this opportunity to say that as advocates and practitioners, it will be important for all of you to weigh in during this rulemaking process to make sure that this new community reinvestment program is structured in a way that most efficiently targets this capital for reinvestment in distressed communities. Next slide, please. So I know I just covered a lot of information sort of in the weeds, so I'll step back for a moment and point to this analysis from Novogradac and Company, which estimates that the final version of the tax bill will cost about 235,000 affordable rental homes over the next decade. The bulk of these units will be lost because of the lower corporate rate and its negative impact on investor demand. And as I mentioned earlier, it is still too early to fully understand how the base erosion tax will impact the industry, but there is likely to be negative impacts to the housing credit and potentially the new markets tax credit because of this new base erosion tax. So the industry is still working to analyze that, and hopefully within the next few months we'll know more. Next slide. Thank you. So turning towards our priorities for 2018, we are committed now to moving forward with efforts to strengthen and expand the housing credit now that its role in the tax code has been reaffirmed. So as you all know, Senator Maria Cantwell has been an exceptional champion of the program, and she remains committed to advancing her bill this year. Her office has actually already identified a number of potential legislative vehicles for her bill, one being the potential upcoming omnibus spending package, which may have a tax component to it. As Rebecca and Caitlin have already mentioned, the appropriations outlook is definitely uncertain, so it's unclear when or even if a fiscal year 2018 budget will be completed. But I did want to flag for everyone that we are contacting co-sponsors and working to set the stage to include the Affordable Housing Credit Improvement Act in that legislative vehicle, hopefully upcoming in February. And as I mentioned earlier, Republican leadership has indicated that they will be considering a tax extenders or technical corrections bill this year. And if that is the case, we will, of course, be working to include the Cantwell-Hatch bill in that tax package. And we have been in touch with both Senator Cantwell and Chairman Hatch's offices about their support for advancing the bill in this manner. Next slide, please. So before I stop to take questions, I do just want to highlight a few of the ways you can get involved in our advocacy work. So first, make sure that your organization has joined the Action campaign. Action is a national coalition of more than 2,100 national, state, and local organizations and businesses advocating in support of the housing credit and housing bonds. Enterprise co-chairs the coalition alongside the National Council of State Housing Agencies, and we have been really excited over really the past year to see such tremendous engagement as local groups reach out to their representatives and activate their own networks to support key programs. I think we all really saw that coalition at work over the past several months. In terms of immediate advocacy, we are asking stakeholders to please reach out to your representatives in both the House and Senate and ask them to make sure that the Affordable Housing Credit Improvement Act is a priority in any upcoming legislation, be it an omnibus spending package, a tax extenders bill, disaster recovery, or some other legislative package. I'll also note that, as always, we are encouraging you to reach out to your Republican representatives, especially those who have been supportive of the housing credit and housing bonds in the past, and thank them for their support and ask that they support the Affordable Housing Credit Improvement Act and share their support for this bill with leadership, so with Chairman Hatch and Majority Leader Mitch McConnell. And then finally, Democrats will play a much more active role in any upcoming negotiations, be it with spending package or tax extenders or whatever it might be. So we do encourage you to, again, reach out to your Democratic members and ask them to make the Affordable Housing Credit Improvement Act a priority and share their support for this bill with Senator Schumer and Representative Pelosi. So next slide, and I will stop there and open it up for any questions that the group might have.
Thanks so much, Olivia. While folks are thinking about questions, I did have, I have two, one that came in, one for me, and that is mine is around new market tax credits. Can you just elaborate on how they were retained? I know the House bill kind of not only repealed them, but took away the previously kind of authorized authority through 2019. So did the final bill continue the program through 2019 and then repeal it, or totally keep it? I was a little unclear.
Yeah, that's a great question. So as you mentioned, the original bill that the House released did repeal new markets immediately starting finishing in 2017. And then the Senate bill was silent on the new markets tax credit. So as I'm sure most everyone knows, the new markets tax credit is not a permanent tax credit. It is currently authorized through 2019. So with the Senate bill being silent on new markets, that means that it was not repealed prematurely. It was still authorized through 2019. And that is the version that was included in the final bill. So that is to say that new markets will continue to be authorized until the end of 2019, and there is, of course, legislation in the House and Senate to permanently extend the new markets tax credit. And with the New Markets Tax Credit Coalition and other stakeholders, we will continue to support this legislation and gain co-sponsors in the months to come.
Thanks, Olivia. That's helpful. Just to clarify for folks, we're talking about the Tax Cuts and Jobs Act, so it really only touched on programs in the tax code. So HUD programs like CDBG and HOME were not addressed in the tax bill. They will be addressed in the appropriations bill, which we hopefully will have sometime soon. So we've had two questions come in, Olivia, slightly different in nature, but one is around, the general rationale for tax reform and lowering the corporate rate is to improve the economy and encourage investment. But from the lens of the housing credit, and you've already mentioned the potential loss of $230 30,000 units. Are there other kind of economic impacts that enterprise and action are concerned are going to happen unless we can kind of make some fixes? We'll start with that question.
Yeah, that's a good question. So I'm sure everyone has seen all of the coverage of the tax bill and the various analyses about how it will impact, people on all different levels of the income distribution. I think in general, there is a concern that even though our, key programs were retained, there might now be moves to cutting programs through the appropriations process that would further, undermine support for the communities that we, try and serve. I would also say that there is a proposal, so more specifically to the housing credit, the industry has developed a proposal that would modify the housing credit formula so that the program could sustain its current production potential even though the corporate tax rate was lowered so significantly. So that is one option that we could potentially pursue. I think at this point the focus is going to be more on securing the Affordable Housing Credit Improvement Act, including that 50% expansion in the allocation authority, with the hope that with those additional resources, we would be able to not only address the shortfalls that were created during tax reform, but then also add additional resources on top of that. Does that clarify?
Yes, thank you. That's it's also helpful to hear kind of about the approach to strategy for fixes and going at the expansion. Makes a lot of sense. So you mentioned opportunity zones as one outcome of the tax reform bill. Since this is a totally new provision or program, do you have a sense kind of who's paying attention or who's going to get engaged on that? We had a question kind of who's working on it. We know Treasury is going to run it, but kind of where that idea came from and who's kind of pushing it forward?
Yeah, absolutely. So this Opportunity Zone program concept came from the Investing in Opportunity Act, which had been introduced last year in both the House and Senate. It had bipartisan support. It was actually a concept that was created and proposed by EIG, the Economic Innovation Group. And the goal really is to activate the billions of dollars in passive capital that could be reinvested into these communities. We are, there's a long way to go before the program is up and running and can actually take investments. So again, I encourage everyone to stay up to date on the process as Treasury goes through that formal rulemaking process. But as it stands, we do anticipate that this, should ideally be a great tool to pair with the new markets tax credit. It's unclear at this point if the investments will be eligible for housing projects, but a lot of that will be up to the way the law is defined in the rulemaking process, and so that's sort of just more incentive to make sure that all of the advocates, stakeholders, practitioners, et cetera, with the experience on the ground are weighing in to help shape the way that this rule and this program comes into being.
Thanks, Olivia. That's really helpful. And then our last question before we close out this section of the webinar, with the potential for a tax extender bill or a fixes bill, are there other proposals related to community development that you anticipate might be in the bill, or things that might, or proposals that y'all are maybe a little concerned about? I know with the tax reform process, we had some, as you mentioned, surprises. So is there anything we should kind of be on the lookout, either positively or negatively, in a tax extender bill?
Yeah, so I think that the fact that the housing credit was retained with such strong support throughout this entire process really does, reaffirm its support, its bipartisan support, its strong track record. So, feeling confident that this program will hopefully continue to have that support, and we're really banking on using this momentum to continue pushing forward and making the case that now that the program has been reaffirmed in the tax code, let's really take this opportunity to strengthen and expand it. Beyond that, though, as you all know, we had a real fire drill with private activity bonds, and we obviously got the outcome that we were hoping for, but there is still a lot of education that needs to be done in terms of bonds. A lot of people, I think, even within the industry, were less clear about the connection between the private activity bonds and the housing credit and the role that they play in the program. And so as we continue having these conversations, especially with, talk of a potential infrastructure package coming up in the next few months, that would be an avenue for private activity bonds to be revisited. We want to just make sure that we continue to educate and make the case for specifically for multifamily housing bonds is a really key part of the housing credit program.
No, that's a really good point to keep in mind, that just because we got to keep private activity bonds in the tax reform bill doesn't mean that we can stop talking about them and their importance when it comes to affordable housing. With that, I'm not seeing more questions come in, so I just want to thank you, Olivia, for joining us. And as you can all, Olivia's contact information has been up there for you, and we will share her slides in a follow-up email if you have additional questions that come to mind. So thank you, Olivia. So next up, we have Dan Sickler with the Mortgage Bankers Association. We're going to switch gears a little bit from rental housing to not even really homeownership, it's more broadly mortgage finance in general, and some things that have changed over recent months that may mean we can move forward on housing finance reform in 2018, maybe not, but it's worth kind of getting an update on where things are at and where they've been and where we're headed. So with that, I'll turn it over to Dan.
Yeah, thank you, Rebecca, and appreciate the chance to be here. Yeah, we're going from a subject we've been talking about for 4 months to a subject we've been talking about for just about 10 years now. For those keeping track, 2018 is the year where we'll hit a decade of conservatorship. So conservatorship is about the age of a 4th grader at this point. One thing that's a little bit exciting about the current policy environment is we actually are starting to see a little bit more momentum and movement on the GSE reform front than we have in a few years now. As Rebecca noted, that may or may not mean something large and comprehensive gets across the finish line, but certainly wanted to give folks a sense of where things stand today. So, on slide 2 of this deck, we always like to start, even before getting into current proposals, with just kind of level setting about the problems that GSE reform is trying to solve and what problems were exposed during the crisis in 08, 09. And, when I think about these, there are obviously a number of issues, but really top line is kind of the murky role that Fannie and Freddie held with respect to their private status versus their public status, technically congressionally chartered government-sponsored enterprises that were privately owned. Just trying to work your way through that sentence kind of shows why this was complicated, and their connection to the government was not always well understood. A couple other points that I think of as really insufficient guardrails around the acceptable activities of Fannie and Freddie in the lead up to the financial crisis. When you think about how they were structured and how they were set up, you really had a congressionally legislated duopoly in the secondary market and in the conventional market. And, you know, without the real ability for them to face competition, outside competition from new firms, there really, the market didn't have a great check on their activities or on their behavior. And that sort of allowed for a situation in which both enterprises could really pursue very aggressive growth targets and market share targets. These, you know, things that I think of as really getting away from their core businesses and being more about the investments they made with their retained portfolios and, you know, some of the riskier behavior that ultimately came back to bite them as the housing market turned downward in 07, 08. And then finally, just another point I always like to raise in terms of real problems, structural problems in the lead up to the crisis, the fact that you had the entities, Fannie and Freddie, that were exposed to mortgage credit risk, also being the ones responsible for the securitization infrastructure in the secondary market, again, at least in the conventional market. It really meant that if you had a problem in the credit space and those entities were suffering losses or potentially going to become insolvent, they necessarily dragged the securitization infrastructure with them, which really essentially guarantees that the market's going to grind to a halt in that scenario. You know, a lot of folks will look at the status quo. Again, you know, we've been in conservatorship for almost a decade and know, you know, somewhat rightly in some ways that the housing market today is not, probably not right to characterize it as broken. You know, loans are getting made, borrowers are getting access to credit. So what is the problem today, or the problem with sticking with the status quo? The first thing, just the fact that you have FHFA as conservator effectively means, for all intents and purposes, they're managing the secondary market. And, you know, you can have feelings one way or another about the government role in that space, but what we have today is not really the product of a conscious policy decision, but more an outcome that we've achieved by necessity in the midst of a crisis. And that leads directly into kind of the second bullet towards the bottom, which is uncertainty about the future of the market, right? And this affects business planning, investments in the market, really hard to take a long-term view on the housing market, whether you're a lender, an investor, some other market participant in the market that we have today. And then finally, just the fact that you still have really striking taxpayer exposure to mortgage credit risk, and that's even despite some of the very positive steps that FHFA and the GSEs have taken over the last decade. So on slide 3, I try to lay out some of what I consider to be the major issues and considerations when thinking about GSE reform. There's obviously, you know, the list can go on and extends far beyond what I have on this slide. But really, I think these are the top line issues. You always hear about this debate framed in terms of the appropriate role of the government in this market. I think of that in two ways. The first is the role of the government in actually guaranteeing mortgage credit and mortgage credit risk. You know, a few different options you can think about. If you're going to have entities like Fannie Mae or Freddie Mac, or maybe it will be Fannie Mae or Freddie Mac in the future, that are purchasing loans, aggregating loans, issuing mortgage-backed securities. When you think about how the government can provide guarantees in that space, what you could do is you could have guarantees by the government on the securities that are issued by those entities. So that would, you know, effectively be explicit government guarantees on what we know today as agency MBS. You could also go a step further and have the government guarantee the actual firms that are issuing the securities. So have the government explicitly stand behind Fannie Mae or Freddie Mac or whatever new entities perform their functions in the future. Or you can go in the other direction and not have any sort of explicit government guarantee. And that could either mean an implicit guarantee like you had in the past, though obviously that turned out to be problematic for a number of reasons. Or, you know, you've had legislative proposals out there that just take the conventional market and really move it in a private direction so that you don't have any firm, explicit government backing. And so regardless of which one of those options which path you go down, there really is a question of how are taxpayers protected and what kind of, again, guardrails are in place. Second thing, in terms of the role of government, really, how does the government help promote affordable housing and access to credit for a broad swath of borrowers? I think about three big ways that happens today, and that's through fees that are charged that ultimately flow into things like the Housing Trust Fund or the Capital Magnet Fund. Affordable housing goals, so quantitative goals about how entities operating in the secondary market are able to purchase loans that meet some sort of affordability definition. And then finally, something Rebecca mentioned before, which is the newly implemented duty to serve plans and how specific markets like rural housing or manufactured housing are addressed. And tied to all of this really is what should be the government's, kind of the market share of the government supported piece of the market. So when you think about the large portion of the market that Fannie and Freddie have served in the past, wide range of opinions about whether that role of Fannie or Freddie or their successor should be expanded, should be contracted, or should stay roughly equivalent to what it's been. Before I move into proposals that are out there, I would just remind folks, we talk about housing finance reform, where the proposals that are out there to either fix or replace Fannie and Freddie really do focus on the secondary market. These are secondary mortgage market reforms. And so at the end of the day, one of the questions any plan has to take a stance on is, do you keep Fannie and Freddie? Do you keep them but reconstitute them in some way? And that can be through regulatory reforms or more basic reforms to the way that they are structured, their ownership, the way they're allowed to operate, or do you eliminate them entirely? Again, that would be more towards options that move you into a more exclusively private market in the conventional space. So coming to proposals and what's been going on, first just for folks' benefit, where have we been post-crisis? Thinking about major legislation in this space post-crisis, obviously Dodd-Frank instituting lots of very important financial sector reforms, a lot of housing-related reforms, particularly around CFPB, issues that folks are familiar with, like the qualified mortgage and qualified residential mortgage standards, many things along those veins. Really nothing to address the GSEs. And so in 2013 and 2014, you saw quite a bit of activity on Capitol Hill to try to very specifically handle Fannie and Freddie specific concerns. This was, you'd often hear folks refer to this as the last great, outstanding, unfinished business of the financial crisis-related reforms. You had a few options, the PATH Act, which was championed by Representative Hensarling. On the House side, you had the Corker-Warner plan, which ultimately became the Johnson-Crapo plan on the Senate side, which is a more bipartisan effort, though ultimately none of those plans ended up crossing the finish line and getting enacted into law. We've really had kind of a dormant period in terms of legislative activity, at least for large, comprehensive reform ideas related to Fannie and Freddie, up until these past couple months. One thing I want to kind of dispel folks of, one notion you hear, or sometimes you see often in the press, is this idea that really nothing has changed with Fannie or Freddie, or nothing's changed in the secondary market during this decade of conservatorship. And really, I would push back pretty strongly against those types of claims, and largely that's due to the efforts of FHFA as conservator over this time period. FHFA has taken on a number of reforms that it has been able to enact administratively in its role as conservator I list a few here. This is not an extensive list or a comprehensive list, but things like eliminating some of the special deals that larger lenders got from Fannie and Freddie in the lead up to the crisis, so you have a more equal and fairer market. Limiting taxpayer exposure, at least somewhat, through the use of credit risk transfers, reducing those retained portfolios at Fannie and Freddie, which I talked about earlier, why those were problematic and contributed to their downfall in the crisis, and then improved infrastructure around the securitization process, the common securitization platform, and the development of a single security that would take the place of the traditional single-family Fannie and Freddie mortgage-backed securities, which historically have been separate securities. So now, after that kind of long intro, wanted to call folks' attention to at least a few of the more prominent plans that have been floated over the past year. Forgive me, I have to start with the MBA plan on the list here, but really each of the first three plans I describe here, MBA, the Milken Institute, and Jim Parrott and a set of co-authors, I would say they are all very similar along a number of dimensions, and really the way I think about those is reconstituting Fannie and Freddie and creating new entities that perform many of what I would think of as the positive functions of Fannie and Freddie, while stripping away some of the baggage and putting up stronger guardrails. There are some differences in the MBA plan. These would be entities that are essentially acting like monoline bond insurers that are issuing securities with an explicit guarantee. In the Milken plan, those entities would be lender-owned mutuals, and they'd be using the Ginnie Mae infrastructure. In the Jim Parrott and co-authors model, Fannie and Freddie would actually be merged into a government corporation that issues those explicitly guaranteed mortgage-backed securities. So important differences, but I do want to highlight that I think there's a lot more in common among those plans than there is different. The last plan I note here, developed by the Mullis company and done on behalf of some of the more prominent Fannie and Freddie shareholders, is what I would call the most comprehensive plan that's out there that actually envisions keeping Fannie and Freddie, keeping them somewhat as we know them today, how to recapitalize the institutions. Folks often hear the phrase recap and release, which would refer to allowing Fannie and Freddie to build up capital again and operate largely as they once did, but again with some important guardrails. That's probably the most well-developed plan that fits the recap and release model. And then finally, I just want to close with sort of where are we heading now, and what are we seeing on Capitol Hill today. Really, the most promising activity has happened on the Senate side. You've already had a series of hearings held by the Senate Banking Committee over the last 6 or so months. Senators Corker and Warner, who've been leaders in this space, again, drafting legislation. We are hopeful that that's something that they'll be able to release in the first quarter of 2018. I'm not going to take that to the bank, but that is the most well-developed of any work that is currently happening on Capitol Hill today. On the House side, again, a set of hearings to explore the issue with financial services. A notable point is that Chairman Hensarling, who had always been a very fierce supporter of the PATH Act that he developed, which is very much a wind down Fannie and Freddie and leave much of their activities to the private market, has signaled a new openness, at least somewhat openness, to other models that might include some form of a more explicit government role and government guarantee. There's some work going on at the staff level, but nothing quite so imminent that we expect legislation to be released anytime in the very near future. And then lastly, the wild card here is what role does the administration play? Secretary Mnuchin at Treasury has a background in housing finance, has stated right from entering his office that he has a commitment to GSE reform, that he doesn't want to leave the question of Fannie and Freddie unaddressed by the time he leaves his post. And, against that backdrop, Mel Watt at FHFA is down to just about a year exactly left in his tenure, and whoever the new director is, who will assume the conservator role, will have quite a loud voice and a large platform in terms of what happens with Fannie and Freddie moving forward. So happy to leave it there and take any and all questions.
So do send questions, folks, and while you're thinking about them, just wondering if you have any insight or secret intelligence into what Warner and Crapo are working on. We've heard, they've kind of, and I shouldn't say they've, their staff have been meeting with different folks and kind of, for lack of a better phrase, shopping around different pieces of the bill. So certain concepts are getting some early attention, but I have yet to talk to anyone who's seen kind of the whole bill, and without seeing the whole bill, it's hard to evaluate any individual pieces. But one thing I've been hearing, is that it is going to be a different approach than previous legislation. For whatever that might mean.
Right. Yeah, it's a good point, because it is hard to judge these pieces without knowing how they fit into the whole. One thing we hear very frequently is one of the complaints about the prior Senate effort, which was bipartisan. This is Corker-Warner in 2013, which became Johnson-Crapo in 2014. One of the big complaints is that it just became a very complicated piece of legislation, very long, a lot of moving pieces, a lot of pieces that touched on not just the secondary market, but regulation and market structure in the primary market as well, lenders, servicers, that type of thing. And so I think one of the main goals of the folks on the Senate side who are working on this today is to really limit what they're doing to a more streamlined approach that really just focuses on the secondary market. And, I think about how they're probably going about that, trying to leverage the existing system, the existing regulatory authority to the extent possible wherever they can. And, a related point is it's a lot easier now in 2018 than that would have been in 2013 or 14, largely because a lot of those FHFA reforms that I discussed earlier. You have a well-developed credit risk transfer market. You have a common securitization platform that's actually operational now. You're a year to a year and a half away from a single security. So, rather than having to, sort of create those things via legislation, you're able to rely on these things as existing infrastructure. So I think my sense is that's kind of the direction they're heading in, or what they're trying to achieve there.
No, that's helpful, and that makes sense. And my other question, so new leadership at FHFA is coming. This is really trying to crystal ball things, but given how far along some of these changes are, like CSP and the single security, is there concern that a new director would walk some of that back, or that they would just kind of slow down moving forward? Yeah,
it's a good question. It's one we wrestle with at MBA all the time. While I wouldn't, I wouldn't say it is very likely that a lot of these major initiatives like the CSP or the credit risk transfer market would be walked back. I think there is any non-zero chance is one that should be concerning to folks. I also think maybe some of the things that are more at risk, depending on who the next FHFA director is, would be things that are less about the infrastructure and more about the FHFA's intervention in the secondary market. And so one example that I do worry about quite a bit is FHFA, as I noted earlier, has really gone a long way towards eliminating any of the special pricing or underwriting deals that Fannie and Freddie used to provide to their largest lenders, their largest customers. And so that's been really great from our perspective because it gives more of a level playing field to, lenders of all sizes, right? The largest banks to the smallest community lenders in terms of accessing the secondary market. You could certainly envision a scenario in which a new director might say that FHFA shouldn't be meddling in, pricing decisions at Fannie and Freddie, and that could potentially open the door to those types of activities that we saw in the run-up to the crisis, which, while maybe not leading to another crisis, would, I think, certainly be a negative, at least for smaller institutions.
No, I think that's a good point, and that's a good way to think about it. I think for a lot of advocates, with reform on the horizon and a new director, there's concern about some of the affordable housing pieces. Yeah. But I think the pricing and the way the market is structured is also really key to affordable housing as well.
Yes, very much so.
So I think it's good to raise that and keep that in mind. And for folks on the webinar, just to give you a sense of NHC's perspective, we will be following housing finance reform very closely. We've been engaged when previous efforts rolled around, and we'll continue to be engaged because we want to ensure that the market serves as many people as possible, as effectively and efficiently as possible. So the overall structure and the certainty that Dan kind of mentioned is really important for that. But we also know, regardless of how we do that and create that market, that there will be market failures. So we need to have some affordable housing pieces to address those failures, and they need to be part of a reform effort. And as I mentioned in my comments earlier, housing finance reform is not just about single family. Fannie and Freddie do a ton of work in the multifamily space. So ensuring that multifamily lending is able to continue at the rate that it is now is also really important as part of reform. And that can be a piece that gets overlooked sometimes. So just want to raise that for folks. And again, again, it's hard to predict when, but the package, the reform bill could come out next week. It could come out in February. So do stay tuned, because getting engaged on that is going to be really important. I know it can feel a little abstract to talk about housing finance reform, but it is very much relevant to the work that you do on the ground. So please think about that. So with that, I will thank Dan for joining us.
Thank you very much.
We're glad to have you, and you can reach out if questions occur to you after the fact. So the last thing I want to touch on before we let you guys go today is a resource that NHC has on our website. And as I'm pulling it up, I'm actually going to interrupt myself and say that I want to flag a couple dates for you, and you can kind of see them on the menu bar. But our budget forum. Oh, pictures. Let me see this. Our February. The date is still being determined, but we will have our annual budget forum webinar. Well, we will talk about what's in the president's budget. We will talk about advocacy strategies, and we'll also touch on some of the policy discussions that we anticipate happening over the coming months, specifically around rent reform. So stay tuned for that. And the other date I want to flag for you is April 17th. We are having our Solutions for Housing Communications convening here in DC at the National Press Club, really focused on communication strategy in general, so different pieces that you could be thinking about as an organization, like podcasts and digital media and how to work with reporters, but also how do you counter community opposition, how do you communicate in times of crisis. So really powerful tools for your work. So do put that on your calendar and plan to attend. So with that, I'm going to show you Nexus. So Nexus is our housing policy guide. This is our kind of reborn, reformatted housingpolicy.org, if anyone's familiar with that resource. But again, we have, as I said, reformatted. So hopefully it's going to be much friendlier for you to use, and the content is still incredibly helpful and valuable. So right now we have 3 sections fully available: funding tools, inclusive communities, and regulatory strategies. Coming, stable neighborhoods, we have part of that section up on foreclosure prevention and recovery. The remaining sections will come up over the coming months, and then sustainable development by spring. So still kind of being posted, but there's a lot here already, and I just want to walk you through it. Assistance for low-income homeownership is one piece of the funding tools section. Every section is laid out the same. So you have an overview page. This one is on homebuyer education and counseling. And we have links to other resources and other organizations. Read through this, that's not the goal here today. It's just to show you that this is here and how it kind of works. I did want to get to the bottom. At the bottom of the resources, so there'll be reports and websites that will drive you to be clear what the next piece of the section is. It's down payment assistance, and then the next piece would be home rehab program profiles. Looks at, for example, and I want to point that out because in every section, whether it's within funding tools or inclusionary housing, we will give you examples of practitioners doing this work. So it's a really helpful resource. The other thing I want to say about it is, I've lost my, hold on. Now bear with me, I've lost my thought process.
Getting back.
So getting back, the easiest thing to do is actually to go to menu and scroll down and go to Nexus that way to get back if you want to look at other funding tools. So there that is. Oh, the other thing I wanted to say is each section has different, clearly different content, but what I'm really trying to get at is some sections are lengthy, some are briefer. So you really have to kind of click in and see what's there. But again, they all will have this overview page, which is a good place to start. Have these additional resources at the bottom, more resources, and then way at the top here. Again, programs, but it clearly focused on inclusionary housing as opposed to homebuyer education. The other thing we wanted to mention about Nexus is this is an ongoing process. So if you are in a particular section and know of a great example that should be in the guide or an update that we should have reflected, please reach out to us and we will get that reflected in Nexus. And if you see a gap in the content, something that's missing, please let us know. As time and funding allow, we're hoping to build more into Nexus. But feel free to reach out to Caitlin and I, again, with updates, with examples, and if there's a gap that you think we should think about filling. Anything you want to say, Caitlin? Okay. So with that, I will release you back into your day. Thanks so much to everyone for joining us. Thanks to our speakers, to Olivia and Dan. Next month, February 7th, we will be focusing on Native American housing issues. Georgie Bama with NARO and Marvin Ginn with Native Community Finance will be joining us to touch on kind of the challenges in that space, but also best practices and lessons learned from their work in that space. So do join us for that. And as always, we will send out follow-up materials and the link to the recording by the end of the week. So thanks, everyone.